Now is Derek Holt, Vice President and Head of Capital Markets Economics at Scotiabank. Derek, thanks so much for making time for us today.
It's my pleasure, Jacqueline.
So we had a lot on inflation this week, from China to the U.S., a couple of different pieces from the U.S., in fact. We had the consumer price index yesterday. We got producer prices today, and then the University of Michigan sentiment survey as well. So a lot to sort of chew on. What is your sense of, the inflation picture in the U.S.? It did come in a touch lower. However, I know that you noted in your note we're a long way from Powell pulling out the pom-poms and doing sky-high leg kicks in a press conference, though I'm not sure we should ever really expect him to be doing that, should we, Derek?
That's quite the image, isn't it? But it's no, I think we're a long way away from that for many reasons, but one of which is the inflation picture. I think markets have very, very short memories, and I think they've forgotten that we've seen 3 previous soft patches in the ensuing periods during just the pandemic era itself. Lit up inflation numbers all over again. And so this could be just the 4th such episode in the pandemic era, and we have to be very careful. And when I look at the drivers of inflation and whether or not they've truly gone dormant, I'm not convinced. I think we're still at a point in time in which inflation risk remains very much alive and well.
And when you're thinking about, the month-over-month gains for inflation in the U.S., there was a lot sort of made out of the 0.2% 2 months in a row. But you noted, and we've got a graph that shows the average monthly core U.S. CPI gains and showing the soft patch, and then the next 3 months after that. It doesn't look like a soft patch really means, more to come on that front.
Yeah, no, I think one consideration is oil prices. They're up $16 a barrel since June or so. We're seeing fairly broad-based commodity price pressures across many of the world's inflation markets, and not just the United States. I mean, there are a few billion people in the world for whom rice is a staple in their diet. Those prices are soaring. In India, tomato and onion prices are a staple and a key component of their CPI basket, and that's expected to put upward pressure upon their inflation numbers next week. We still have economies in Canada, the U.S. and elsewhere that are still relatively tight and at capacity constraints with very tight job markets. Wage pressures are intense. In the United States, month-over-month annualized wage gains are about 5%. In Canada, that same measure has been eclipsing month-over-month inflation ever since the past year. And so we're starting to see that evidence of real wage gains over that period of time, in no small part because of a lot of the collective bargaining agreements that have lit up on the wage side of the picture. So now is not the right time to go soft on inflation risk.
Yeah, we've got another one of your graphs, Derek, showing that the wages outpacing inflation in this country. And I wonder, does that put more pressure on the Bank of Canada in particular? Because we've also got your comparison here of wage growth in the U.S. versus Canada. So does that put more pressure on the Bank of Canada than it does on the U.S. central bank?
I think it may. It harkens back to a piece back in the spring by the IMF's economists, whereby they said that the greatest risk that collective bargaining wage settlements spill over into the broader labor market is in countries with high unionization rates and tight labor markets, and that characterizes Canada. We have a 30% unionization rate that's tripled out of the United States at 10%, and the highest across North American and European powers, with only Belgium and Italy higher than Canada. And we have a very tight job market, and we have very poor productivity growth defined as output per hour worked. And so the wage gains, I understand the pressures on household finances. Everybody's trying to get a little bit bigger share of the pie here, and I don't blame them for that. They're under a lot of pressure at the margin, but the accelerating wage gains and wage settlements and the average hourly wages that we're observing are well in excess of productivity. And at the margin, I think that's going to be a combination of inflationary factors.
I wonder, the recent rate hikes by the Bank of Canada, how much of an effect do you think that those latest 2 are going to have? Because we just heard from Canadian Tire withdrawing its financial forecast this week, and mentioning these rate hikes in particular as, weighing on consumer demand. Do you see this as sort of, maybe the tipping point where we really do start to see the effects of these rate hikes being felt?
It's possible, but some of the company news is trading off against each other in this kind of a market. And so, for example, we've heard airlines coming out in Canada with some pretty buoyant numbers. And so the composition of spending is changing a little bit away from some types of short-lived economic goods with lives of under a year or thereabouts toward more of the services side of the picture. And so the aggregate numbers are still showing a fairly resilient consumer in Canada. I would expect that picture to calm down as we go off into next year, but still, there too, we have some signs of resilience. We have a very, very tight housing market with no inventory. We're adding population growth into it, and so house prices are starting to inflame some of the inflation risk coming out of that sector. We have a very tight job market, accelerating wage gains. We have wealth effects operating on the consumer, including what's happened to stock markets. The U.S. S&P 500 is up 25% since last October, and we have accelerating house price gains in both Canada and the U.S. And so the consumer dynamic, I think, is nowhere near as bad as it's often portrayed in terms of a lot of the popular discussions.
Yeah.